So, in the 1990s, the global financial system sort of quietly mutated.
Oh, massively.
Yeah, like a massive multi-trillion-dollar shadow market was just born.
Yeah.
And it was built entirely on trading something that, doesn't actually possess a physical form.
No form at all.
Yeah, I mean, something you can't put in a vault, you can't load it onto a cargo ship, and you definitely can't hold it in your hands. And that something is risk.
Pure risk.
Exactly.
Yeah.
Financial engineers basically figured out how to isolate the pure abstract fear of things going wrong.
Yeah.
And then they slapped a highly specific price tag on it.
And just traded it back and forth.
Right, across the entire globe. So welcome to today's deep dive.
Yeah.
And if you are tuning in right now, we know exactly why you're here.
Oh, we definitely do. Yeah.
You are staring down the barrel of your corporate finance syllabus. Specifically, the notoriously dense material covering Chapter 18.
Derivatives and risk management.
Yep, derivatives and risk management.
It's a beast. It really is a beast of a topic.
It is. It's so dense.
Because the mechanics of these instruments, they can easily feel like a completely foreign language when you first see them.
Oh, absolutely.
But, I mean, understanding this architecture is arguably the most profoundly important step in grasping how modern global capital actually flows. You cannot run a multinational corporation today without operating these exact levers.
So we are going to tear this architecture down to the studs today.
Yeah.
The whole mission of this deep dive is to completely unpack the underlying logic of, forwards, futures, options, and swaps.
The big four.
The big four, exactly. We aren't just going to sit here and recite textbook definitions. We're going to build real-world scenarios, trace the money step by step, and really understand the exact mechanisms of how these tools work.
Because once you get the why and the how, you don't really need to memorize the formulas.
Right.
The logic just kind of locks into place.
It just makes sense, which is the perfect approach for mastering this for your exam. Because before we can even touch the instruments themselves, the derivatives, we have to deeply analyze the fundamental condition they were invented to manage, right? We have to talk about the philosophy of risk.
Yeah, you have to start there. Because usually, when we hear the word risk in a corporate setting, it sounds like a liability.
Right, it sounds like a bad word, something you want to just completely eliminate from your spreadsheet.
But there's a fundamental paradox here. The core engine of business is investing capital, taking on risk, and extracting a compensatory return. You just can't have the return without the risk.
So wait, if I'm stepping into an executive role, and I know that investing inherently requires risk to generate yield, why am I suddenly spending, millions of dollars on a risk management department to eliminate it? I mean, aren't I just capping my own upside?
Well, that's the essential tension right there at the heart of corporate finance. And the answer is that risk management is absolutely not about eliminating risk.
Huh?
Because, think about it, if you eliminate all risk, you just default to the risk-free rate.
Which is what, like treasury bills?
Exactly. You're basically just holding short-term government treasury bills. You won't make a real profit. And inflation will just slowly eat your capital alive.
Right, right.
So the goal isn't elimination, right? It's optimization.
Optimization.
Yeah, you are trying to strip away the uncompensated risks, the chaotic sort of existential threats that you have absolutely no edge in managing.
So you can focus on what you're actually good at.
Exactly, so that you can concentrate your capital on the risks you actually want to take, the risks that generate your core return.
Okay, so it's really about clearing the noise so you can hear the signal. And historically, there was a massive shift in how companies viewed this, right? Like prior to the 90s, risk was often just seen as the cost of doing business.
Yeah, just a hazard.
But then it became this formalized front and center obsession. So what exactly triggered that mutation we talked about at the start?
Well, it was kind of this perfect storm of macroeconomic shifts. You had sweeping deregulation of global financial markets.
Oh, yeah.
And they were dismantling all these rigid exchange controls, coupled with this aggressive push by corporations to capture international market share.
Oh, right. Globalization really taking off.
Exactly. Suddenly, a regional company wasn't just worried about the local economy anymore. They were operating in this highly volatile, interconnected global environment.
So, like, a currency crisis in Asia could overnight wipe out the profit margins of I don't know, a manufacturer in Ohio.
Precisely. The stock markets just became hyper-reactive, and corporate boards realized they could no longer just sit back and let global volatility dictate whether they survive or not.
They had to actively manage it.
They had to actively measure and manage it, yes.
Which brings up that old business cliche, right? What gets measured gets managed.
It's a cliche for a reason.
True. But when you're dealing with global finance, it is like an absolute law of gravity. Because what cannot be measured mathematically cannot be managed. You can't hedge a feeling.
No, you definitely can't.
You have to quantify the actual exposure.
Exactly. And once you quantify that exposure, you have to decide what to actually do with it. So in corporate project finance, there is this fundamental triad, a three-part framework for how a company can allocate that quantified risk.
And for the MBA students listening, write this triad down.
Yes, absolutely. You either transfer it, you retain it, or you share it.
Okay, let's make this super concrete for the listeners.
Yeah.
Let's say I'm managing a consortium building a massive $5 billion hydroelectric dam.
Okay, big project.
Huge. It's a 10-year project. The variables are astronomical. How do I apply that triad? Let's start with transferred risk.
So transferred risk is when you legally shift the financial burden of an outcome to a third party via some kind of contract.
Like insurance.
Exactly like insurance. So in your dam project, let's say there is a significant risk that a catastrophic flood just washes away the entire foundation during year 2 of construction.
That would be bad.
Right, and you don't have the balance sheet to absorb a total rebuild. So you go out and you buy specialized construction insurance. You pay a premium, and you transfer that specific flood risk entirely to the insurance syndicate.
Okay, makes sense. I literally just hand the problem to someone else for a fee.
Yeah.
So what about retained risk?
Retained risk is the exposure you deliberately choose to keep. And you usually do this because it's either way too expensive to transfer or it just falls within your acceptable operational margins.
No stuff you can handle.
Right. Let's say there's a risk of minor weather delays, like a few weeks of heavy rain that halts the pouring of concrete on your dam.
Oh.
You calculate that buying a derivative or an insurance policy to cover a measly 3-week delay would actually cost more than the delay itself.
Oh, so the math just doesn't work.
Exactly. So your company retains that risk. You just absorb the potential minor hit to your profit margin because trying to hedge it would be, economically inefficient.
Got it. And the third bucket in the triad is shared risk.
Yeah, and shared risk is exactly what it sounds like. It's an arrangement where the burden is distributed between multiple parties.
So it's like a joint venture.
Exactly. In a massive infrastructure project like your dam, you might have a public-private partnership. The government really wants the power grid upgrades, but you are the one bringing the construction expertise.
Right.
So you might structure a contract where if the price of raw steel spikes globally by more than 20%, you agree to absorb the first 10% of the cost overrun.
And then the government takes the rest.
Yes, the government agrees to subsidize the rest. You are actively sharing the volatility.
Okay, so transferred, retained, shared. It's basically a constant sorting exercise. But to sort the risks, you actually have to know what kind of volatility you're facing.
Right, you need to identify the threats.
Yeah, and we've talked about floods and steel prices, but the true underlying currents of modern business are the big 3 financial risks. The invisible forces that can bankrupt a company without a single physical disaster even happening.
Yeah, these are the silent killers.
Let's break these down, starting with the really heavy hitter. Interest rate risk.
Oh, this is a big one. So interest rate risk is the danger that shifting baseline interest rates will erode the value of your assets or inflate the cost of your liabilities.
And for anyone studying for this exam, the absolute baseline mechanic you must internalize here is the inverse relationship between interest rates and existing bond prices.
Very important.
When interest rates rise, bond prices fall.
They fall.
I really want to pause here and drill into the why of this
Welcome
mechanic
on.
because I know it trips up so many students. It sounds totally counterintuitive. I mean, if rates go up, shouldn't my investment go up? Let's trace the actual money.
Okay, let's do it.
Imagine I'm an institutional investor. I buy a $10 million corporate bond that pays a 5% fixed interest rate for the next 10 years. I'm locked in. What happens mechanically if, say, the very next year, the central bank raises rates and brand new bonds are now being issued at 7%?
Well, here is the harsh reality. You are holding a piece of paper that pays 5%. But the rest of the market can now easily go out and buy a brand new piece of paper that pays 7%.
Right.
So if you suddenly need liquidity, like you need cash now, and you want to sell your 5% bond to another investor, Why would they ever buy it from you at face value?
Because they could just get the 7% one.
Exactly, they wouldn't touch it. So to make your 5% bond mathematically as attractive to a buyer as the new 7% bonds, you have to heavily discount your asking price.
Ah, I see.
You might have to sell your $10 million bond for, say, $8 million. You have just experienced a massive capital loss.
Wow.
And that drop in price, that is the literal manifestation of interest rate risk.
And I assume it cuts both ways, right?
Yeah.
If the economy totally tanks and the central bank slashes rates down to 3%, my 5% bond suddenly looks like a golden ticket.
Oh, everyone wants it then. You can sell it at a huge premium.
But there's a duration component here too, isn't there? Like a 30-year bond is going to swing much more violently in price than a 3-month treasury bill if rates change.
Exactly. The longer the maturity, the greater the price volatility. Because if you are locked into a suboptimal rate for 3 decades,
That's a long time.
the compound effect of that disadvantage is enormous. So the upfront price must be discounted severely. But if you're only locked in for 3 months, the market barely cares. The adjustment is tiny.
Okay, so as a corporate manager, you are constantly watching macroeconomic indicators to anticipate these swings. And the primary driver, like the ultimate puppet master pulling the strings of interest rates, is inflation.
Always inflation.
Right, because rising inflation forces central banks to hike rates to cool the economy, which then crushes bond prices. Moderating inflation allows them to lower rates. If you are modeling inflation, you are just flying blind.
Which leads us directly into the second of the big three: foreign exchange risk or Forex risk.
Oh, Forex risk. This one is fascinating to me because you can run a flawless operational quarter, crush your sales targets, keep all your costs down, and still report a massive financial loss purely because of math occurring on a currency trading desk in London.
Yeah, that is the brutal reality of Forex risk. It is the danger that an asset or liability or operational cash flow denominated in a foreign currency will lose value when you have to convert it back to your domestic currency.
Okay, let's use an example.
Let's use a tech hardware company based in California as our model. They manufacture components in the US, but their largest consumer market is in Germany. So they sell their hardware in euros.
Okay, so let's say they project a profit of 10 million euros for the quarter. And when they made that projection, let's say 1 euro is equal to exactly $1.
Nice and simple.
Right. So they are telling their shareholders in California to expect a $10 million profit.
Exactly. But over the course of that quarter, a massive geopolitical event occurs, and the euro significantly weakens against the dollar. Now, it takes 1.2 euros to equal $1.
Okay, so the tech company's European sales team, they did their job perfectly, right? They collected the 10 million euros from their customers.
They absolutely did. But when the corporate treasury department actually repatriates that cash, when they convert those euros back into dollars so they can pay their U.S. employees and report their earnings, that 10 million euros is now only worth roughly $8.3 million.
Oh, wow. They just watched $1.7 million vaporize into thin air.
Gone.
And they didn't lose market share. Their product didn't fail. The ground literally just shifted beneath their feet. That's Forex risk. And it affects both importers paying for foreign good and exporters repatriating foreign profits.
It hits everyone operating across borders. And finally, we have the third major category, which is price risk.
Right.
This is the inherent dynamic volatility of the underlying markets themselves, whether we are talking about equity stock markets or raw physical commodities.
This feels like the most visible risk, honestly. Like, if you are a global airline, your entire profit margin is inextricably tethered to the price of petroleum.
Oh, 100%.
If crude oil spikes because of a supply chain shock, your operating costs just explode. And you can't just instantly double the price of a plane ticket for a flight leaving tomorrow. The consumer just won't pay it.
No, they'll just cancel their trip. And managing price risk requires an organization to clearly define its risk appetite. You can take a conservative approach, which acts a lot more like traditional insurance.
Like what?
For example, an investor holding a massive equity portfolio might buy put options, which, by the way, we will dissect in detail shortly, to protect against a sudden market crash. You pay a premium up front, but you cap your downside.
But there's also a highly aggressive end of the spectrum, right? You don't just have to cower in fear of price drops. You can aggressively exploit them.
Oh, absolutely.
Things like short selling, where you borrow an asset, sell it immediately, and then hope to buy it back cheaper later to pocket the difference. Or utilizing inverse exchange traded funds that are literally designed to go up when the core market goes down.
Yeah, the overarching takeaway for the financial strategist or the MBA student is that these three forces, interest rate risk, forex risk, and price risk, they are constant, unrelenting pressures.
You cannot ignore them.
You have to actively build structures to withstand them.
And that perfectly brings us to the tools.
Yep.
We've diagnosed the diseases. We've seen the sheer destructive capability of these forces. Now, let's look at the actual financial engineering that was developed to tame them. It is time to define the derivative.
Let's do it. At its absolute core, a derivative is a financial contract whose value is entirely dependent upon or derived from the performance of an underlying entity.
An underlying entity.
Right, and that underlying entity can be almost anything. It could be an equity share, a foreign currency, a physical commodity like wheat or oil, or even an abstract index like an interest rate benchmark.
This is the conceptual leap that I think can be really tricky for people. A derivative has zero intrinsic value of its own. It is basically a ghost. It is a shadow.
I like that. A shadow.
Yeah, let's use that analogy.
Oh.
If you look at the shadow of a skyscraper, the shadow has no physical substance. You can't touch it.
Right.
But its length and its direction are flawlessly mathematically tied to the height of the building and the position of the sun. If the building sways, the shadow moves. A derivative is the shadow. The underlying asset is the building. You are literally trading the shadow.
That is an excellent way to visualize it. And legally, the definitions can be incredibly broad to capture this reality. For instance, if you look at the Indian jurisdiction under the Securities Contracts Regulation Act of 1956.
It's the SCR?
Yes, the SCRA. A derivative is legally codified to include instruments derived from debt, shares, loans, or even what they call a contract for differences.
What is a contract for differences?
It's literally just an agreement to pay the difference in an asset's price between the time the contract is opened and when it's closed. You never even touch the asset.
It's purely a math equation.
Yeah.
Let's ground this in the classic foundational origin story of derivatives, though, the agricultural hedge.
The classic example.
Imagine a wheat farmer in the Midwest. It's April. He has planted his fields, and he knows he will harvest 10,000 bushels of wheat in September. Right now, wheat is trading at a great price, say $8 a bushel. At that price, he can pay off his equipment loans, feed his family, make a solid profit.
But he doesn't have the wheat yet.
Right.
He has to wait 5 months. And in those 5 months, global weather patterns might produce a massive bumper crop everywhere else in the world, flooding the market with wheat and driving the spot price down to $4 a bushel.
And if that happens, he goes bankrupt. He is facing catastrophic price risk.
So he looks for a cure. He goes out and finds an industrial bakery that needs to buy wheat in September to make bread. Now, the bakery is terrified of the opposite problem. They're terrified that a drought will cause wheat prices to spike to $12 a bushel, destroying their profit margins.
So they have opposing fears.
Exactly. So the farmer and the bakery sign a contract today. The bakery agrees to buy the 10,000 bushels in September for a locked-in price of $8 a bushel, regardless of what the open market is doing at that time.
That contract is a derivative. Its value is entirely derived from the future spot price of wheat. By signing it, both parties have executed a hedge. They have effectively transferred the price risk away from their core operations.
But here is the critical dual nature of this market that you need to understand. You don't actually need a farmer and a baker to create a derivative.
Wait, really?
Not at all. You just need two people willing to take opposite sides of a bet. One party can be hedging a real-world physical asset, while the counterparty is just a Wall Street speculator sitting in a skyscraper who has never set foot on a farm in his life, simply betting that the price of wheat will go up.
Oh, I see. So it's basically a side bet on the main event.
Precisely. And that speculation provides the necessary liquidity for the actual hedgers to find willing partners to take on their risk. It's a highly symbiotic ecosystem.
Okay, so before we look at the specific contracts themselves, we really need to understand the environments where these trades actually happen. Because not all derivatives are created equal, right? The infrastructure matters immensely.
It dictates everything. So broadly, we have exchange-traded derivatives, or ETDs, and over-counter derivatives, or OTCs.
Okay, let's break down the infrastructure.
Okay.
ETDs, exchange-traded derivatives. These are traded on massive, highly regulated public exchanges, like the Chicago Mercantile Exchange. What is the defining characteristic here?
Standardization. That is the key word to remember. Standardization. An ETD is a completely rigid, standardized contract. The exchange dictates the exact size of the contract, the specific quality of the underlying asset, and the precise expiration dates. It is completely non-negotiable.
Got it. Think of it like building out your company's IT infrastructure by just going to Amazon Web Services and buying their standard off-the-shelf cloud storage package. You get 10 terabytes of data for a flat monthly fee. You can't call Jeff Bezos and ask them to customize the server hardware for your specific weird software.
Or you take the standard package.
But the benefit is it's highly transparent, the pricing is public, and if you don't need it anymore, you can easily cancel it because millions of other people use the exact same standard package. It's highly liquid.
Exactly. It's a volume game. Now, contrast that rigid standardization with over-the-counter derivatives. OTCs.
Okay.
OTCs do not trade on a public exchange. They are private, bespoke agreements negotiated directly between two counterparties, and it's often facilitated by an investment bank behind closed doors.
So, using our tech analogy again, an OTC derivative is like deciding you don't want AWS. You hire an elite engineering firm to custom build a proprietary liquid-cooled data center on your own private land using highly specific processors calibrated only for your company's exact algorithm.
Yep, you get exactly what you want. Every single term of an OTC contract, the strike price, the exact maturity date down to the minute, the specific formula for calculating the underlying asset is completely custom tailored to the buyer's unique risk profile.
But there's a massive trade-off for that level of customization, isn't there?
There is illiquidity.
Oh.
Because the contract was engineered specifically for your bizarre, highly unique corporate situation, there is virtually no secondary market for it. If you change your mind 6 months later and want to offload that contract, you can't just sell it on a public exchange.
Because nobody else wants your weird custom-built data center.
Exactly. You are essentially locked in with the original counterparty.
Okay, so we have standardized public exchanges on one side and customized private backrooms on the other. Now we can finally dive into the specific instruments themselves. And to really grasp this, we need to trace the evolutionary timeline.
Start from the beginning.
Yeah, we have to start with the oldest, most primitive form of a derivative, the forward contract, and understand why it eventually had to evolve into the modern futures contract.
So let's lay the foundation. A forward contract is an OTC derivative. It is a private, customized agreement between two parties, and it establishes a strict obligation.
Obligation.
Yes. The buyer, which is known as the long position, is obligated to purchase an asset. The seller, known as the short position, is obligated to sell that asset at a pre-agreed price at a specific future point in time.
Obligation is the operative word.
Yeah.
You are legally bound.
Yeah.
And you can write a forward contract on almost anything, right? The commodities markets use them for grain, precious metals, crude oil.
Natural gas, sure.
But the financial markets use them extensively too, right? For foreign currencies and debt instruments.
They absolutely do. Let's construct a scenario to see how this actually resolves in the real world. Let's introduce Global Fruit Corp, which is a massive distributor, and Farmer John, who owns an enormous apple orchard.
Okay, Global Fruit Corp and Farmer John.
Global Fruit Corp needs apples in exactly 3 months to fulfill a big grocery store contract. They negotiate a private forward contract with Farmer John to buy 10,000 kilograms of apples at $2 per kilo for delivery in 90 days.
Okay, fast forward 90 days. The contract reaches maturity. How do they actually settle this obligation?
Well, there are 2 distinct mechanisms for settlement. The first is physical delivery. This is the traditional route. The 90 days are up. Farmer John physically loads 10,000 kilos of apples onto a fleet of trucks, drives them to Global Fruit Corp warehouse, unloads them, and Global Fruit Corp hands him a check for $20,000.
The asset physically changes hands.
Yes, the physical asset moves. This is known as a deliverable forward.
That seems simple enough for apples. But what if our forward contract was based on an abstract financial index? Or like a massive quantity of foreign currency that neither of us actually wants to hold in a physical bank account?
That is where the second method comes in, cash settlement.
Okay, so non-deliverable.
Correct. In a non-deliverable, cash-settled forward, nobody delivers any physical assets. Instead, on the maturity date, the two parties simply look at the current open market price of the asset, the spot price, and they compare it to their contract price.
They just look at the math.
Right. They calculate the difference, and whoever lost the bet simply writes a check to the winner.
Let's do the math on that. Imagine Farmer John and Global Fruit Corp agreed to a cash-settled forward instead. The contract says $2 per kilo. But on day 90, there's been a massive apple shortage, and the open market spot price is now $3 per kilo.
Right.
Global Fruit Corp looks like a genius. They locked in the right to buy at $2 when the market is at $3. They have a $1 advantage per kilo.
Exactly. So instead of delivering trucks full of apples, Farmer John simply calculates that $1 difference across the 10,000 kilos, and he wires Global Fruit Corp a cash payment of $10,000.
Wow.
Then, Global Fruit Corp takes that cash, combines it with their original budget, and just goes out into the open market to buy the apples they need. The net financial result is exactly the same, but the friction of physical delivery is entirely removed.
That is incredibly efficient. Okay, so that's the forward. It's customized. It does the job.
Hmm.
But there is a massive gaping hole in the architecture of a forward contract, right? Like a fatal flaw that almost broke early financial markets.
Oh, absolutely.
Let's talk about counterparty risk.
This is the critical vulnerability of OTCs. A forward contract is only as strong as the integrity and the financial solvency of the person sitting across the table from you. Let's go back to Farmer John and the apple shortage. Now, the market price spikes to $3. Farmer John looks at his contract to sell to you at $2. He realizes he is going to lose a massive amount of potential profit. So what if he just defaults?
What do you mean?
What if he secretly sells his apples to someone else at $3 and just ghosts you? Or worse, what if a blight wiped out his crop entirely and he literally goes bankrupt?
Then I am left holding a worthless piece of paper. I have 0 apples, my grocery store clients are furious, and my business is ruined. And I have no institutional guarantee because the market is entirely unregulated. It's just a private promise.
Exactly. And that terrifying reality, that high counterparty risk, is precisely what drove the evolution of the futures contract. The market desperately needed a mechanism that allowed the hedging of risk without the paralyzing fear that the other guy would simply walk away from a losing bet.
Enter the futures exchange.
Yes.
Right. A futures contract is the evolutionary offspring of the forward. It still represents an obligation to buy or sell at a future date, but structurally, it is an entirely different beast. Let's compare them directly for the exam.
We established that forwards are private, bespoke, and unregulated. Futures, on the other hand, are exchange-traded derivatives. They are rigidly standardized, publicly quoted, and heavily regulated by government bodies, such as the Commodity Futures Trading Commission in the U.S.
But the real magic trick of the futures contract is how it completely obliterates counterparty risk. And it does this through an entity called the clearinghouse.
This is a brilliant piece of financial engineering. Listen closely to this part. When you trade a futures contract, you are not actually contracting with Farmer John.
Wait, really?
No. The moment a buyer and seller agree to a trade on the exchange, the clearinghouse steps right into the middle and legally splits the transaction.
Okay.
The clearinghouse becomes the legal buyer to every seller and the legal seller to every buyer.
It's like an ultimate invulnerable middleman. If I'm the buyer, I don't care if Farmer John goes bankrupt, because my contract is actually with the multi-billion-dollar clearinghouse. They guarantee the settlement.
You do.
But wait, if the clearinghouse is guaranteeing thousands of trades a second, aren't they taking on an apocalyptic amount of risk? How do they protect themselves?
They protect themselves through 2 strict mechanical requirements: initial margin and daily settlement, which is also known as marking to market.
Let's dive deep into this, because this is where the theory becomes operational reality. If I sign a forward contract with Farmer John, neither of us usually puts any money down on day one. We just promise to settle in 90 days. But the futures exchange doesn't trust promises.
Not at all. To open a futures position, both the buyer and the seller must deposit a percentage of the contract's total value into a brokerage account. This is the initial margin.
Okay.
It's essentially a performance bond.
Yeah.
A good faith deposit to prove you actually have skin in the game.
But the real teeth of the system is the daily settlement, mark to market. I want to trace this over a 3-day period so the listener can practically see the bank accounts moving.
Good idea.
Let's say I go onto the futures exchange and I take a long position. I agree to buy 1,000 barrels of oil in 3 months at $100 a barrel. The guy taking the short position agrees to sell at $100. We both deposit our initial margin. Day 1 ends. What happens at 4 p.m. when the closing bell rings?
At the closing bell, the clearinghouse takes a snapshot of the market. Let's say big geopolitical news broke, and the spot price of oil surged to $105 a barrel.
Okay.
Your long position is highly profitable. You lock in the right to buy at 100, and it's now worth 105. You made $5 a barrel. The short position lost $5 a barrel.
In a forward contract, we would just write that down on a piece of paper and wait 3 months to settle up. But in a futures contract,
In a futures contract, the reckoning is immediate. The clearinghouse literally reaches into the short seller's margin account, extracts that $5 per barrel loss, and directly deposits it into your margin account that very evening.
Wow.
The contract is then mathematically reset to the new baseline price of $105 for the start of day 2.
The money actually moves every single night. Let's look at day 2 then. Let's say the market panics, overcorrects, and oil plummets to $98 a barrel. So the price drops $7 from our new baseline of $105. Now I'm the loser.
Exactly. So that evening, the clearinghouse reaches into your account, pulls out $7 per barrel, and hands it to the short seller. They reset the baseline to 98. This happens every single trading day until the contract expires.
That is ruthless efficiency. By forcing everyone to settle their debts every 24 hours, the clearinghouse ensures that nobody ever gets so deeply into a losing hole that they're tempted to default and run away.
Exactly. The losses are chopped up into manageable daily bites. If your margin account gets too low from a string of losing days, you get a margin call.
Right, a margin call.
Yeah, you either deposit more cash immediately or the exchange forcefully liquidates your position.
And because of this continuous daily cash flow, the vast majority of futures contracts, like well over 95%, never actually result in physical delivery, right?
Almost never. The participants simply execute an equal and opposite trade to close out their position before the expiration date, and they just walk away with their net cash gain or loss.
Okay, so looking at this architectural evolution, futures are regulated, transparent, standardized, and structurally immune to the counterparty default risk that plagues forward contracts.
Right.
So let me play devil's advocate. If futures are so incredibly superior in their safety and efficiency, why do OTC forward contracts still exist? Why take the risk of the dark, unregulated market?
Well, it all comes back to the trade-off we discussed earlier, standardization versus customization. A massive corporate hedging operation often just cannot fit its risk profile into a standardized off-the-shelf ETD box. If you are an airline hedging jet fuel, you might need a highly specific grade of aviation fuel delivered to a very specific regional hub on, say, the 17th of the month.
Okay.
But the Chicago Mercantile Exchange only offers standardized crude oil contracts expiring on the 1st of the month.
So they don't match up.
Right. The mismatch, which is called basis risk, is just too great for the airline.
So they happily accept the counterparty risk of a forward contract with a major investment bank because they desperately need the bespoke, custom-tailored terms. It's a calculated trade-off.
Precisely. And while forwards and futures solve the problem of locking in a future price, they both share one distinct characteristic. They are absolute obligations. You are trapped in the trade.
Right. Whether the market moves for you or against you, you must execute the contract.
Right.
But what if a financial engineer looked at that and said, what if I don't want an obligation? What if I just want the choice? What if I want to pay for optionality?
That is a brilliant, devious question.
And it brings us to the most versatile instrument in the arsenal. Let's transition to options.
An options contract is a fundamental paradigm shift. It is an agreement that gives the purchaser the right, but crucially, not the obligation, to buy or sell a particular asset at a predetermined price on or before a specific expiration date.
The right, but not the obligation. It transforms a rigid financial commitment into a flexible strategic choice. And it comes in two distinct flavors, right? The call option and the put option.
Let's define them clearly for the students. A call option gives the owner the right to purchase the underlying asset at a specific price, which is known as the strike price.
The strike price.
Yes. You typically buy a call when you are bullish, when you anticipate the market price of the asset is going to rise above your strike price.
Conversely, a put option gives the owner the right to sell the underlying asset at the strike price. You buy a put when you are bearish or seeking insurance, when you anticipate the market price is going to fall below your strike price.
Now, because this contract grants a powerful privilege without imposing an obligation on the buyer, the seller of the option, the person who is obligated to fulfill the terms if the buyer chooses to exercise their right, well, they demand upfront compensation.
Naturally.
This non-refundable upfront cost is called the option premium.
I love utilizing a real estate analogy here because it perfectly illustrates the asymmetrical risk.
Let's hear it.
Imagine a commercial real estate developer looking at a massive, empty lot on the edge of a rapidly growing city. They think a major tech company is going to announce a new headquarters nearby next year, which would make that land incredibly valuable.
Okay.
The lot is currently priced at $5 million. But the developer doesn't want to sink $5 million in cash today. just in case the tech company chooses a different city.
Smart. So what do?
So the developer goes to the landowner and proposes an option contract. The developer pays the landowner a non-refundable $100,000 premium today. In exchange, the landowner grants the developer the exclusive right to purchase the land for exactly $5 million, the strike price, at any time over the next 12 months.
Okay, fast forward 8 months. The tech company officially announces the new headquarters right next door. Commercial zoning explodes, and the open market value of that empty lot skyrockets to $15 million. What does the developer do?
They immediately exercise their call option. They legally force the landowner to sell them the property for the agreed-upon $5 million strike price. The developer then flips it on the open market for $15 million. They just made a $10 million gross profit, all stemming from a $100,000 premium payment.
The leverage is astronomical. But let's look at the alternate reality. Fast forward 8 months, and the tech company decides to build in a completely different state. Not only that, but a waste management facility buys the land next door.
Oh, worst case scenario.
Yeah, the open market value of the lot plummets to $2 million.
If the developer had used a forward or futures contract, they would be legally obligated to buy that land for $5 million, suffering a massive $3 million loss.
But because they hold an option, they simply do nothing.
Just walk away.
They choose not to exercise their right. They let the contract expire worthless. Their total loss is strictly limited to the $100,000 premium they paid up front.
The downside is capped, but the upside is theoretically limitless. That asymmetry is why options are so incredibly popular. And structurally, the timing of when you can walk away or exercise that right depends on the regional style of the contract. The industry differentiates between American options and European options.
Right, and it's mostly just a geographical naming convention. They both trade globally. An American option provides maximum flexibility. It can be exercised at any point in time prior to or on the expiration date.
Whereas a European option is highly restrictive. It can only be exercised on the exact day of expiration.
Correct. But the absolute core competency required to understand options, the math that dictates whether these contracts are actually worth anything at a given moment, is a concept called moneyness.
Moneyness. If you are prepping for a corporate finance exam or managing a corporate portfolio, you have to be able to calculate moneyness instinctively.
You really do. Moneyness describes the relationship between the underlying asset's current market spot price and the option's contractual strike price. It determines whether exercising the option right now would result in a positive cash flow.
And there are 3 states, right?
Yes. At the money, in the money, and out of the money. Let's walk through the mechanics for both calls and puts.
Let's use a tangible commodity to keep the logic grounded. Let's use a massive copper mining operation and a manufacturing company that builds electric vehicle batteries. Let's start with at the money.
At the money is the easiest state to grasp. It occurs when the market spot price of the copper is exactly equal to the option strike price. If you hold a call option to buy copper at $4 a pound, and the open market is currently trading copper at $4 a pound, you are at the money. The same is true for a put option to sell at 4 when the market is 4.
Because there's no intrinsic advantage to exercise in the contract. Why use your option to buy it for $4 when you can just call up any broker and buy it for $4 on the open market? It's a neutral state.
Exactly.
But things get violent when we move to in the money. This is the state of profitability. Let's look at a call option first.
A call option, the right to buy, is in the money when the strike price is significantly lower than the current market price. For example, your EV battery manufacturer holds a call option to buy a ton of copper at a strike price of $5,000.
Right.
Suddenly, global supply chains constrict, and the market spot price for copper rockets up to $8,000 a ton.
Let's trace the logic on that. I hold a legal document giving me the right to buy this essential material for $5,000. Everyone else in the world is currently bleeding cash, forced to pay $8,000. My contract allows me to bypass the market chaos and acquire the asset at a steep discount. I am holding an incredibly valuable document. I am in the money.
Now apply that logic to the put option, the right to sell. A put is in the money when the strike price is higher than the current market price.
Okay.
Let's look at the copper miner. They spent millions extracting the ore. They need to sell it. They hold a put option with a strike price of $6,000 a ton. But the global economy slows down, demand evaporates, and the market spot price crashes to $3,000 a ton.
If the miner didn't have that put option, they would be selling their copper for $3,000 and likely going bankrupt. But because they paid the premium for that put, they have the contractual right to force the counterparty to buy their copper at the $6,000 strike price, even though it's currently only worth half that on the open market.
They secured an artificial, highly profitable selling price. They are in the money.
Which leaves the final state out of the money. This is when exercising the option would result in an immediate mathematical loss.
Yes. For a call option, this happens when the strike price is higher than the market price. You have the right to buy at $10, but the market is selling at $7. You would never exercise that.
And for a put option, it's out of the money when the strike price is lower than the market price. You have the right to sell at $4, but the market is happily buying at $9. Again, the option is completely useless to you in that moment. You just let it sit there or let it expire.
And this leads to a fundamental conclusion about the asymmetrical risk profiles of options versus futures. Because an option buyer can simply choose not to exercise an out-of-the-money contract, their maximum possible loss is strictly limited to the premium they paid up front.
Their profit potential, however, is theoretically unlimited if the market moves violently in their favor.
Exactly, whereas a futures contract, as we established, binds both parties to the outcome. It carries unlimited profit potential, but also unlimited catastrophic loss potential for both sides. If you are wrong on a futures contract, you can lose everything. If you are wrong on an option, you just lose your deposit.
Which is exactly why these tools attract very different strategies. Options are beloved by corporate hedgers seeking predictable insurance costs. Futures are heavily utilized by aggressive speculators willing to endure high volatility for massive leverage.
Yep.
Okay, we have covered future obligations with forwards and futures. We have covered future choices and asymmetric risk with options. Now we have to look at the financial engineering used by the largest institutions on Earth to fundamentally alter their underlying debt and cash flow structures without ever going to a bank. Let's move to the masterclass of corporate finance. Swaps.
Swaps are fascinating. They are sophisticated over-the-counter derivatives. They are private agreements between two massive corporate entities to exchange ongoing streams of cash flows into the future based on a prearranged mathematical formula.
Conceptually, you can think of a swap as a portfolio of multiple forward contracts strung together over a period of several years.
That's exactly what they are. These aren't tools for retail traders. These are massive strategic maneuvers used to manage long-term interest rate and currency exposures. The primary text outlines two distinct categories. Let's tackle the interest rate swap first.
Okay, what is it?
An interest rate swap is an agreement to exchange one stream of interest payments for another over a set period. The most common instruction is exchanging a floating variable interest rate for a fixed interest rate.
Let's build a scenario to demonstrate why two companies would actually do this and how the money actually moves. Let's introduce Tech Giant Inc. and Old Bank Corp.
Okay, Tech Giant and Old Bank.
Tech Giant took out a massive $500 million loan to build data centers. But the loan has a variable interest rate tied to the overall market. Recently, inflation has been surging, and Tech Giant's CFO is terrified that their interest payments are going to skyrocket, crushing their quarterly earnings. They desperately want the security of a fixed, predictable interest rate.
Meanwhile, Old Bank Corp has a $500 million portfolio of fixed-rate mortgages. They are receiving a steady, unchanging stream of income. But Old Bank's economists believe interest rates are going to rise significantly.
And if rates rise, Old Bank is stuck earning the old, lower fixed yield.
Right. They desperately want to convert their fixed income into a floating rate that will ride the wave upward.
So we have two entities with completely opposing risk profiles. Tech Giant has variable and wants fixed. Old Bank is fixed and wants variable. They find each other through an intermediary and negotiate an interest rate swap. Now, here is the crucial mechanical question for anyone taking an exam on this. Do they actually swap the $500 million of underlying principal? Do they trade the actual debt?
Absolutely not. The text and the mechanics are explicitly clear on this. The principal amounts are never exchanged.
Why not?
Attempting to refinance or trade a $500 million syndicated corporate loan facility would involve months of legal hurdles, banking syndicates, and massive frictional costs.
Instead, they use that $500 million purely as a mathematical baseline, what is called a notional principal.
Exactly. Notional principal. They keep their own original loans, but they agree to swap the obligation of the interest payments calculated against that $500 million notional amount.
So, Tech giant agrees to pay Old Bank a fixed 5% interest stream. In return, Old Bank agrees to pay Tech giant a floating interest stream tied to the market rate.
It's pure financial alchemy. If the floating market rate spikes to 7%, Tech Giant's original bank demands higher payments. But it doesn't matter because Old Bank is simultaneously handing Tech Giant the cash to cover that 7% floating rate, while Tech Giant is only handing Old Bank the agreed-upon 5%.
They have effectively synthesized a fixed-rate loan without ever tearing up their original paperwork. It's like realizing your car engine isn't suitable for the terrain, but instead of buying a new car, you just wirelessly swap horsepower outputs with a truck driving next to you.
That's a fun way to think about it. It is an incredibly elegant risk management tool. Now, contrast that mechanism with the second type of swap detailed in the text, the currency swap.
A currency swap involves exchanging streams of payments in different currencies. And here, the mechanics regarding the principal amount are fundamentally different, right?
Yes. In a currency swap, the counterparties actually do exchange the corresponding principal amounts at the very start of the contract, and then they exchange them back at the exact same exchange rate at maturity.
Let's trace why they have to do that. Let's introduce US Auto, an American car company wanting to build a factory in Japan. They need 10 billion Japanese yen to pay for local labor and materials. Simultaneously, Japan Tech wants to build a research facility in Silicon Valley, and they need 100 million US dollars.
Now, US Auto could try to borrow yen directly from a Japanese bank,
Yeah.
but they are a foreign entity. They don't have deep relationships there, so the Japanese bank is going to charge them an exorbitantly high interest rate.
Conversely, Japan Tech faces the exact same problem trying to borrow dollars from an American bank.
But US Auto can borrow dollars incredibly cheaply at home, and Japan Tech can borrow yen incredibly cheaply in Tokyo.
Precisely. So they utilize their comparative advantages. US Auto borrows $100 million domestically at a low rate. Japan Tech borrows 10 billion yen domestically at a low rate. Then they enter into a currency swap.
They literally swap the massive piles of principal cash on day one. US Auto gets the yen they need for their factory. Japan Tech gets the dollars they need.
And then over the next 5 years, they swap the interest payments to service each other's original domestic loans. And at the end of the 5 years, they swap the massive principal amounts back, allowing them to finally pay off their domestic banks.
They both secured the foreign capital they needed while completely bypassing the punitive foreign interest rates. And they entirely immunized themselves against any forex risk during those 5 years because the exchange rate for the final swap back was locked in on day one.
It is the ultimate tool for multinational corporate expansion. By mastering swaps, options, futures, and forwards, we've officially mapped the entire derivative arsenal. But tools are meaningless without understanding the people wielding them. We need to look at the ecosystem itself.
Exactly. Who is actually sitting at the table in these massive exchanges and dark OTC backrooms? The underlying text segments the market participants into 4 distinct psychological and operational profiles.
The hedgers, speculators, arbitrageurs, and margin traders.
Yes. To truly understand how they interact, we shouldn't just define them in isolation. Let's throw all 4 of them into a single highly volatile market event and watch how they react.
I love that. Let's imagine an unprecedented freak winter freeze descending on the state of Florida. The entire orange crop is in danger of being destroyed. The underlying asset is orange juice futures. Let's introduce our first participant, the hedger.
Hedgers are the foundational participants. They are corporations or individuals with a tangible, real-world exposure to the underlying asset. They aren't in the derivative market to get rich. They are in it to survive.
So in our Florida freeze scenario, the hedger is Tropicana. Their entire business model relies on buying cheap oranges, processing them, and selling juice at a stable margin.
If the freeze destroys the crop, the spot price of oranges will quadruple. Tropicana's profit margins will be annihilated. They can't just double the price of a carton of juice at the supermarket without losing all their customers to apple juice.
So Tropicana rushes into the derivatives market to aggressively buy forward and futures contracts, locking in the price of oranges before the freeze fully hits. They are buying financial insurance to protect their physical operations.
But Tropicana needs someone to actually sell them those contracts. They need someone willing to take on the risk that the freeze will destroy the crop. Enter our second participant, the speculator.
The speculator is the person sitting in an air-conditioned office in Chicago who doesn't own a single orange tree and has zero interest in ever drinking a glass of juice. They are individuals or hedge funds who take a calculated view on the future direction of the market and deploy capital to profit from price movements.
Speculators look at the meteorological data for Florida. Some might look at the freeze and bet it's going to be worse than expected, so they buy futures hoping the price spikes further.
Others might look at the data and bet the freeze will miss the major agricultural zones. They take the short side, happily selling futures contracts to Tropicana at a premium, betting that the price of oranges will actually crash when the harvest comes in completely unharmed.
Speculators often get a bad reputation in the media as gamblers. But structurally, without the speculator aggressively seeking profit, the hedger has absolutely no one to transfer their risk to. The speculator provides the essential liquidity that keeps the engine of corporate finance running.
Exactly. Now, while the hedgers and speculators are battling over the future of the orange crop, our third participant is scanning the market for something entirely different: the arbitrager.
Arbitragers do not care if the price of oranges goes to the moon or crashes to zero. They don't take a directional view on the asset at all. They are hunting for inefficiencies. They are looking for a completely riskless profit.
How does that work?
An arbitrager operates by simultaneously taking opposing positions in the same asset across different markets. Let's say, amidst all the chaos of the Florida freeze, the algorithmic systems at the Chicago Mercantile Exchange price an orange juice contract at $10. But due to a microsecond delay, the Intercontinental Exchange in London prices the exact same contract at $10.02.
The arbitrager's high-frequency trading algorithm detects that 2-cent discrepancy. In a fraction of a second, the algorithm buys 10,000 contracts in Chicago at $10 and instantaneously sells 10,000 contracts in London at $10.02.
They lock in a guaranteed 2-cent profit across millions of units with absolutely zero exposure to the actual weather in Florida. They execute a theoretically riskless trade.
And by doing so, their immense buying and selling pressure instantly forces the Chicago and London prices back into alignment, right?
Exactly. Arbitragers act as the gravitational force that keeps global markets efficiently priced.
Which brings us to the final and most dangerous participant: the margin trader.
Margin traders are essentially a highly aggressive subset of speculators. What defines them is their utilization of leverage, that payment mechanism peculiar to derivative exchanges that we discussed during the mechanics of the clearinghouse.
Right, the initial margin. The fact that you don't have to put down the full value of the contract, the text specifically quantifies the danger and power of this. It notes that this leverage allows a trader to control a position 3 to 5 times larger than their actual capital investment would allow in a traditional cash market.
Let's contextualize that multiplier. Imagine an amateur day trader looking at the Florida freeze. They have $10,000 in their brokerage account. If they were trading in the traditional stock market, they could buy exactly $10,000 worth of an agricultural ETF. If it goes up 10%, they make $1,000.
But in the derivatives market, that $10,000 isn't a purchase price, it's a margin deposit. The exchange might allow a 5x leverage ratio, so the margin trader uses their $10,000 deposit to control $50,000 worth of orange juice futures. It is literal financial jet fuel.
If the trader is right and the market moves up 10%, they don't make 10% on their $10,000 deposit. They make 10% on the $50,000 controlled asset. They just generated a $5,000 profit on a $10,000 account, a massive 50% return on equity.
But leverage is a double-edged sword with no hilt. If the market moves against them by just 10%, they lose $5,000. Half their entire net worth is wiped out in a single afternoon. If it moves 20% against them, their account is entirely liquidated.
The margin trader brings explosive volume to the market, but they are constantly operating on the razor's edge of total ruin. As you step into your corporate career, you have to know exactly which profile you are embodying on any given trade.
And part of embodying that role is speaking the language flawlessly. You cannot walk into an investment banking interview or sit for an advanced corporate finance exam without absolute precision in your vocabulary. Let's lock in the foundational terminology before we wrap up.
Good idea. Let's do it.
We're going to run a deep dive glossary lightning round. I will approach these terms conceptually, how they function in the real world, and I want you to synthesize the precise academic framing that a professor or a managing director demands. Let's start with a callback to our forward contract discussion: credit risk.
Credit risk is fundamentally the risk of counterparty default. Academically, it is defined as the risk of loss arising from a counterparty failing to meet their obligations or, and this is a crucial addition, from a pejorative change in the credit status of that counterparty that causes the market value of their obligations to decrease.
Oh, so it's not just them going completely bankrupt. If a major ratings agency downgrades the counterparty's corporate debt from AAA to junk status, the perceived value of my OTC contract with them instantly plummets because the market suddenly doubts their ability to pay. That downgrade is a manifestation of credit risk.
Exactly.
Okay, next term, hybrid security. My conceptual guess is that it's a Frankenstein product, mashing two distinct financial instruments together into one package.
That is an accurate conceptualization. The formal definition is any security that integrates more than one distinct financial component. A classic corporate example is issuing a standard fixed-income debt note, but embedding a foreign exchange option or a commodity price option directly into the covenant. It allows corporations to fine-tune their capital raising to appeal to highly specific investor risk appetites.
Okay, next we have a critical pairing from our options discussion. Intrinsic value versus premium. My real-world understanding is that the premium is the sticker price I pay to the seller. Intrinsic value is the raw math of whether the contract is profitable right now.
To elevate that to the academic standard, intrinsic value is the true economic value of the financial contract, entirely distinct from its time value. The most effective mental model for an MBA student is to imagine the intrinsic value as the exact payout if the option were magically transformed into a forward contract expiring at this exact second. And mathematically, for an option, intrinsic value can never be negative. It is bounded at zero.
Because if it's out of the money, I just walk away.
Yeah.
My intrinsic value is zero, not a negative loss.
Precisely. The premium, then, is the total upfront cost associated with acquiring the derivative. It is calculated by adding the intrinsic value to the time value. The longer the duration until expiration, the higher the mathematical probability that the market could swing wildly in your favor. The seller charges you for that probability. That charge is the time value.
Excellent. Now, this next term sounds like a literal superpower in finance. Look-back options.
It is perhaps the most exotic and advantageous structure available to a buyer. A look-back option grants the owner the right to execute the contract at the absolute most favorable price that occurred over the entire lifetime of the contract.
Wait, let me make sure I'm grasping in the mechanics here. If I buy a one-year look-back call option on a stock, I don't have to guess when the bottom of the market is. At the end of the year, I can literally look back at the historical chart, point to the single lowest daily price that occurred over the past 365 days, and say, I will buy it at that exact price.
That is exactly how it functions. You have the retroactive right to buy at the historic low or sell at the historic high. Naturally, because this provides an almost guaranteed optimization of profit for the buyer, the upfront premium charged by the seller for a look-back option is astronomically high. It is a luxury instrument.
Incredible. Okay, next. Mark-to-market accounting. We saw this in the clearinghouse daily settlement. It's the daily snapshot.
Formally, mark-to-market accounting is a valuation method strictly suited for financial instruments, wherein open contracts are systematically revalued at regular intervals, usually daily using prevailing open market spot prices. It prevents the accumulation of hidden losses on a corporate balance sheet by forcing the immediate recognition of current market realities.
You can't hide a massive loss and pretend your contract is still worth the original purchase price. You have to mark it to the current market reality. Finally, the last major operational term, netting. My conceptual understanding is that it's like settling a complex bar tab. If I owe my friend $100 for dinner, but he owes me $80 for concert tickets, we don't write each other two separate checks. We just net the difference, and I hand him a $20 bill.
That is the exact underlying logic. In global finance, netting is the process where overlapping cash flows occurring in two directions between two counterparties are mathematically consolidated. Instead of initiating massive, gross, two-way wire transfers, they execute a single net payment resolving the difference. This fundamentally reduces the friction, the transaction costs, and crucially, the settlement risk involved in the exchange.
And with that, we have fully deconstructed the architecture. Let's do a final structural recap of the journey we just took. We began by redefining risk, not as a terror to be blindly eliminated, but as a quantifiable, manageable force that must be optimized into transferred, retained, or shared buckets. We isolated the big three macro forces constantly pressuring a balance sheet: interest rate, forex, and price risk.
We then explored the evolution of the cure. We saw how the primitive, highly customized, counterparty-heavy forward contract structurally evolved into the transparent, standardized, daily settled futures contract guaranteed by the clearinghouse.
We unlocked the asymmetric power of options, understanding how the right, rather than the obligation combined with the mathematics of moneyness, can cap downside risk while maintaining infinite upside potential. We scaled up to the corporate mastery of swaps, demonstrating how massive institutions trade the obligations of their underlying principal debt to synthesize entirely new financial realities.
And finally, we mapped the psychology of the ecosystem. The defensive hedgers, the liquidity-providing speculators, the riskless arbitrageurs, and the highly leveraged margin traders.
If you can internally map those mechanisms, if you can trace the money moving through the clearinghouse and conceptually build a synthetic fixed-rate loan using a swap, you aren't just memorizing formulas. You're fundamentally understanding how modern global capital breeds. You are fully prepared to tackle the complexities of Chapter 18.
The transition from theory to operational fluency is the defining leap of a successful financial career. The tools are now in your hands.
But before we officially sign off, I want to leave you with a final provocative thought experiment. It's directly inspired by a seemingly throwaway line buried deep within the academic material we just analyzed. The source explicitly mentions that derivatives have been structurally engineered to mitigate risks as completely abstract as the weather. Now pause and really think about the implications of that.
It means the fundamental architecture of a derivative is not limited to traditional financial assets.
Exactly. If financial engineers can figure out how to isolate something as chaotic, unpredictable, and uncontrollable as rainfall or winter freezes, and successfully convert it into an underlying asset for a tradable, priced financial contract, then the boundaries are limitless. So look around your own industry. Look at the operational bottlenecks of the tech firm, or the supply chain, or the logistics company you're going to manage. What other everyday, seemingly unquantifiable uncertainties in your business model could theoretically be isolated, packaged, priced, and traded on a secondary exchange? How do you hedge the unhedgeable? Finding the answer to that question and engineering the contract to solve it, well, that might just be your first billion-dollar idea. Good luck navigating the markets, and we will catch you on the next deep dive.